Recently, I have read the book Warren Buffett and the Interpretation of Financial Statements by Mary Buffett. It has explained in very simple language how to read a balance sheet, and I have also shared some insights on how Warren Buffett reads the balance sheet of a company. In this video, I will share with you the concepts I have learned after reading this book. This video is the second part of how to read a balance sheet. I would recommend you to watch the previous parts before you watch this. In our previous part, we covered the headings under current assets and learnt what current ratio means. In this video, we will understand other headings that come under asset section of a balance sheet. So let's continue. First heading we are going to discuss is property, plant and equipment. Company's property value of equipment it uses to manufacture products is represented by this number. To calculate this number, company simply takes the current value of the property, plant and equipment and deduct the depreciation from it. As per Warren, if a company is working in a highly competitive environment, then it has to upgrade its equipment more often even before they wear out. And this brings huge expense overhead just to stay competitive in the market. Therefore, companies with products that do not change that often and enjoy unique competitive advantage does not have to upgrade their equipment so often and hence do not have to spend large amounts on it. Moreover, the companies we are looking for generate so much cash that they can buy new equipments without taking loads of debt. If we take example of Wrigley's, they have 1.4 billion worth of equipment with 1 billion in debt and an earning of 500 million per year. On the other hand, General Motor has 54 billion worth of equipment, 40 billion in debt and is losing cash instead of making it. I think now you get an idea. Next heading in the balance sheet is goodwill. When a company acquires another company by paying more than its book value, the excess is recorded under the heading goodwill. Usually a company with unique competitive advantage never sells below or at its book value. Hence a consistent increase in good value means that the company is doing acquisitions. On the contrary, if the goodwill is consistent, it can mean that either the company is not doing any acquisitions or is buying another companies under their book value. Not much is provided in the book for this heading. However, as per the father of value investing Benjamin Graham, it is wise to deduct the goodwill from company's total assets while evaluating that company, as this is an intangible asset. In other words, do not consider goodwill in any of your calculations while evaluating a company. Which brings us to the next item in the balance sheet, which is intangible assets. These are the assets which we cannot touch, like patents, copyright, brand, etc. Earlier companies can value these intangible assets as per their wish and had misused it a lot in the past. However, now companies are not allowed to value it internally. This is also the reason you may not find this heading in the balance sheet of many companies nowadays. One thing I would like to mention here is company's earnings is very important. If a company's earnings are good and is able to increase it consistently over the years, it is the first sign of a great company with unique competitive advantage. Next heading in the balance sheet is long-term investments. These are the long-term investments made by the company in stocks, bonds or real estate. Long-term investments mean longer than 1 year. What is interesting about this number is the value of this investment is based on the cost or market price of the investment, whichever is lower. Which means if the value of the asset has increased tremendously, it will not show in the balance sheet. For example, if you bought the shares of a company for $50 and after 1 year it reduced to $20, then in the balance sheet, company will value it at $20. However, if the company bought the shares of another company at $50 and after 1 year it has increased to $100, then in balance sheet, company will value the long-term investment based on $50 instead of $100. This is what is meant by cost or market price, whichever is lower. So, if the company is making investments in durable companies with unique competitive advantage, then this long-term investment can do wonders for the company, like we have seen for Berkshire Hathaway. And if a company is investing in poor or mediocre businesses, then it's meant to be doomed. So pay close attention to the acquisitions made by your favorite company and evaluate the acquired businesses as you might have if you have acquired them or purchased them with your own money. Last heading under assets section of balance sheet is other long-term assets. These are the assets that have useful lives of greater than 1 year and cannot be part of property and equipments or goodwill or intangible or long-term investments. Few examples are prepaid expenses and tax recoveries that are due to be received in the coming years. This heading does not tell much about the company's unique competitive advantage, so let's move ahead and check next term in the balance sheet, which is return on assets ratio. Add current and long-term assets and you will get total assets. To determine how efficiently the company is using its assets, investors came up with a ratio called return on asset ratio, which is the net income divided by the total assets. In general, larger this ratio is, better it is. But at the same time, it means there is a vulnerability in the durability of company's unique competitive advantage. Let's understand it with an example. As we all know, some businesses are difficult to enter because of large capital requirement. So companies that have high entry price will have better durability of their competitive advantage, as it will be difficult for new players to enter the market. However, if the entry price is low, the durability of competitive advantage is lower, as it is easy for newcomers to enter the market. Sounds simple, right? If we take examples of Coca-Cola and Moody, Coca-Cola has assets of around 48 billion and return on asset is 12%, while Moody has assets of 1.7 billion and 43% return on assets. Of course, business dynamics of Moody is better than that of Coke. However, its durability of competitive advantage is lower as compared to Coke. This ends our second part of this video series. See you in the next part, where we will learn what each heading under liability section of a balance sheet means.